Hello, everybody. Good afternoon or good morning, wherever you're joining from. Welcome to our session on cash flow statements. What are they? How to prepare them? And all sorts of fun stuff. We've got a huge session today. Almost 250 people registered, so it should be really, really good. We'll be kicking off soon, so let's do a bit of housekeeping while we wait for more people to come in. Next slide, please. Thank you. So as usual, don't be shy. Say hi in the chat. Test out the emojis at the bottom of Zoom and tell us where you're joining from. But if you got a question that you want our instructor to answer, please put that in the Q&A so that we don't miss it. And of course, there'll be, as usual, interactive questions throughout the webinar today. So feel free to participate. We'll be asking you to put your comments down in the chat when the time is ready. And as usual, this session is being recorded and replays are available for team and VIP subscribers. Okay, just before I introduce our instructor, I just wanted to remind everyone our next free event will be the federal budget update, which is coming out on the 9th of May. And so we'll be having our update on the 10th of May, as usual, 12:30 Melbourne, Sydney time in the afternoon. Please register for that. We'll be opening registration soon. Get onto our mailing list so that you don't miss out on that. So we'll be putting the mailing list link on the chat very, very shortly. Awesome. Let me introduce you to our instructor today. So everybody knows Alastair Abbott. He's our resident accounting standards person, instructor, and he's a director of Australian audit, and he does all sorts of accounting statements from small trusts to large corporates, AFSLs, and charities as well. So please put your emoji hands together to welcome Alastair Abbott. Hey,
Good morning, good afternoon, everyone.
You're joining us from somewhere very exotic today.
Yes, I'm outside of Australia at the moment, and while the rest of you, I think, have got some slightly colder weather, I'm very glad for the air conditioning, and it's something like 40 odd degrees outside, so makes
And
it.
where is that?
So I'm in Thailand at the moment, coming to all of you. So it's only 9:30 in the morning for me.
Amazing. Well, thank you. Good morning. And which part of Thailand?
I'm in the about 4 or 5 hours drive north from Bangkok, so staying at my mother-in-law's house for a short while before I'll be back in Perth in 2 weeks.
Wonderful. Yeah, it's great to be able to, yeah, do this wherever you are. So wonderful. So welcome. And yeah, why do you think we got so many regis interest in this topic today?
So I guess
What is it
cash flow
about cash
statements,
flow?
interesting topic because I find everyone I talk to seems to say they're difficult. I don't like them. I can't make them work. Yet they're so common. We have to use them so frequently. So I thought great opportunity to try and give a bit of guidance on how you can do them. And hopefully by the end of the session, you'll be thinking they're actually not that difficult. I don't have to be scared of these things.
Yeah. Okay, let's see then, because I am, yeah, pretty frightened of the cash flow statement from my days doing the CA financial statements, and we had to wreck a cash flow, so that was quite traumatic. So, yeah.
So let's see if I can hopefully make it a bit easier. So what I'm going to go through today, I'm going to jump into what cash flow statements are, why we do them, who has to prepare cash flow statements, a little bit of the theory sitting there behind them, and then I'm going to pull up some worked examples and actually talk you through how we can complete a cash flow statement and how I find is the easiest way to do it and in a way that you're guaranteed to make it balance. That might sound a little bit surprising to some of you, but let's just start with a bit of interaction from everyone. So I want to see, what words do you think of when you hear cash flow statement or statement of cash flows? So jump in the chat. Some of you might be thinking, I've put a couple of words there, or perhaps on the other end, a few other words that things I thought you might associate with cash flow statements. So jump in the chat, type in some words there. What do you think of when you hear the word cash flow statement? How does it make you feel? Or alternatively, if words are a little bit too difficult, if it's a bit too early in the day for you, just put in a number. Where are you on that scale of 1 through to 5? 1 being I run away when I hear the word cash flow statement. 5 being I could do them all day. I love them.
Well, we got 1 5 in there. Good on you, Faz. Um, I love what you said about, yeah, if it's too early in the day for me, for you.
I thought some people might want to go with words, so I've given you the numbers option because we're a bunch of accountants here. So maybe Joyce, can you, if there's a few comments coming through, read them out because I can't see
Yeah.
the
Yeah,
chat
for
where I
sure.
am.
Messy, worthwhile, difficult to reconcile, screaming emoji, the howl from May, unnecessary evil from our Nugget admin person, uh, Assistant Nugget. Good to have you back, Assistant Nugget from Japan. I've almost forgotten your name. But for me, it's yeah, difficult. Oh, and
So
why can't the software just get it right? Yeah, exactly. Yeah.
So hopefully, if I do my job well, by the end of today, everyone will have moved a little bit further towards the green end, away from the red end of the spectrum. But let's see how we go. So, jumping into it. What is a cash flow statement? Just by way of starting point, let's just have an overall look at what are we looking at today? What are we trying to achieve? What does the end goal look like? The picture I've put on the right-hand side there is a direct copy straight out of the accounting standard that shows us an example of how a cash flow statement might be prepared. The cash flow statement is there to show us the movements or the changes in cash over time. So we have to group things between 3 categories. We're looking at operating, investing, and financing. And you can see on the side there, you've got a section of cash flows from operations, a section of cash flows from investing activities, finance activities, and then right at the bottom, what was the cash at the beginning, what was the cash at the end, and what was the movement between the two. On the face of it, it seems reasonably simple. There's not that many different line items that you're going to put in there. We're getting rid of all of the accounting adjustments, so shouldn't that make it easier, right? And if you're looking for any guidance, we just jump into AASB 107, which is the accounting standard that's going to tell us exactly how we do cash flow statements. It's not that long. There's only about 10 pages in the accounting standard that make up the standard itself. And then outside of that, a few other pages of guidance and examples. But if you can look at something like what we've put here, we're really saying, what was the money received from customers? What did you pay to suppliers, employees? A little bit of income tax. And then for many of our clients, the investing and financing section might have nothing in there or might only have a single line item. And so it, on the face of it, should be simple. But when we go and try and calculate the numbers of what we need to put in each category, it can become a bit difficult because all of our accounts are there prepared on an accruals basis. So how do we dial it back to get to an actual cash basis? So I'll talk you through how we do that later, but let's jump in and just have a closer look at what each of those sections are, just making sure we really understand what are we wanting to achieve, what should the end result look like. So let's also look at who has to prepare cash flow, because if you don't have to prepare them, well, why would you? Isn't it easier just not to do it, right? So if you're doing general purpose financial statements, whether that's tier 1 or tier 2 simplified disclosure, you always must have a cash flow statement. If you're preparing compliant special purpose financials, now when I talk about compliant special purpose, these are the ones where you have something in the financials or in the note 1 that says, I'm applying AASB 101, or I'm applying AASB 107, or I'm applying AASB 1054. If you say you're complying with any of those 3, you must have a cash flow statement. So the other category is if you've prepared financial statements and your note 1 says, I am complying with Australian accounting standards. If you've got those 3 words, capital letters, Australian accounting standards, you must have a cash flow statement. If your note 1 says we're complying with accounting principles or something a bit vague or a bit general, you might be able to get away without. But if you've got those words, Australian accounting standards, you must have the cash flow statement. And then anyone else by choice, if you want to, there's nothing stopping you putting it in. The area where you can avoid or don't have to prepare cash flow statements is where you're doing the super special purpose, not the compliant special purpose, but the ones where you don't say applying Australian accounting standards. So that's more your tax basis accounts for giving to mum and dad business owners, or otherwise, as you might regularly as part of a tax return prepare a set of financials. There you can avoid putting in the cash flow statement. So if we think about a few examples, in the for-profit space, examples that would have to prepare a cash flow statement, you've got your large proprietary limiteds, AFSL holders, small foreign owned. In the QBCC space, whether it's annual reports or MFR reports, always have to have a cash flow statement. If you think in the not-for-profit space, if you're submitting through to ACNC, if you're a medium or a large charity, so that's your 500,000 a year turnover and up, you always must have a cash flow statement. And there's a few incorporated associations, like in Western Australia, if you're an incorporated association, a not-for-profit, and you're not registered with ACNC, again, in that medium and large category, you have to prepare cash flow statements. So you can see there's really a broad group of types of entities that need cash flow statements. So it's something we have to do very often. So if we can do it a bit more easily, well, bonus. And why would we do it? In theory, the cash flow statement provides useful information to the people reading the financial report. It helps them make economic decisions based on the ability of the entity to generate cash. The standard actually says it in this words. It says all entities need cash for essentially the same reasons, regardless of what their main activity is. It's kind of quite a mandatory section of everyone uses cash pretty much for the same sort of reasons, so understanding how you're spending, how you're receiving is going to be very helpful. Everyone's needing it to give returns to their investors and to conduct their operations. So with the importance of cash, having a statement that says, let's get rid of the accounting adjustments and show the actual cash movement can become very beneficial and very useful. So I said initially we split it between 3 categories. The operating category is talking about your principal revenue producing activities that you receive or pay cash for. The investing section is about your long-term assets, your property, plant and equipment, the loans you might give out where you're expecting a return. And the financing section is about contributed equity and borrowing. So that's the transactions with shareholders, the how we get money in. So if you think about those categories, we're trying to group the funds based on what's most appropriate to that business. It's not so much a legalistic what's the definition, but more how does it apply in that individual business. And they give examples like if you're a bank, giving and receiving loans is your main part of your operations. So that's going to come into the operating section rather than being investing or financing. Another example might be that ordinarily purchasing land would be seen as an investing activity, but if you're in the business of buying and selling land, that might come into the operating section. So you've got those 3 main categories: operating, investing, and then financing. It's very much a substance over form type of approach we're dealing with. So I've got a couple of questions here to get you thinking. So I've been talking a while. Hopefully I've explained a little bit about what are operating, investing, and financing. And so I've picked 7 transactions here. And for each one, what I want you to think about is, would this transaction be coming into the cash flow statement as an operating activity, an investing activity, or a financing activity? If you think you know the answers straight away, you can start putting them in the chat, but otherwise just start noting it down or thinking about it. Think about these 7 questions I'm going to go through, and then I'll give a little bit more detail about each of the operating, investing, financing, and then we'll come back to the answers a bit later after that.
We've got a lot of responses already.
Oh, so this one's obviously an easy one where
Okay.
everyone knows the answer.
Yeah, yeah.
Daily till takings in a cafe. Bank interest received. Is that going to be operating, investing, or financing? So you can, if you're putting them in the chat, just put number 1, 2, 3 with the O, I, or F next to it, or just note it down on your page. We'll come back in a few slides to the answers to these. The repayment of a Div 7A loan by a shareholder of the company. Where's that going to sit in the cash flow statement?
Tricky one.
Maybe making them a little bit more complicated.
Yeah.
Issuing an invoice to a customer. Rent paid by a landlord for occupancy, or sorry, rent paid to a landlord for occupancy of the factory business premises. The proceeds on the sale of a motor vehicle, and payment of staff wages. Final one, dividend paid to a shareholder. So 8 questions. Some of you might already know the answers to all of them. Some of you might be a little bit unsure, don't want to put your answer in quite yet. So start thinking about those, and I'm going to go through, give a little bit more detail about each of these sections, and then we'll come back and chat through what the actual answers to these questions might be. So the operating section. Operating activities are the principal revenue producing activities of the entity and any other activities that are not investing or are not financing. So it's basically your catch-all section where it's going to have the majority of transactions sitting in that operating section. Examples always make it a bit easier because theory and words is great, but what are we actually talking about? So operating section, this is going to be the cash receipts on the sale of goods, cash receipts on the rendering of services, royalties, fees, commissions, cash payments to your suppliers, cash payments to your employees. Income taxes paid is going to sit there in operating section as well. And anything related to contracts or dealing or trading purposes. So you can see it's really those cash transactions for the main bulk of your operations that sits there in the operating section. You then have the investing section. This is talking about the acquisition and also the disposal of long-term assets, things that are not cash equivalents, because obviously if you've got cash equivalents there in the cash section. So here we're looking at things that are meant to generate future income, things that should generate cash flows into the future. So you're thinking about, and sorry, I should also clarify, it's only things that create an asset on your balance sheet that can potentially be an investing activity. So if it's a transaction that's resulted in an expense, it can't be an investing activity just straight off the bat. So what are we talking about? It's the payment or the proceeds when you buy or sell property, plant and equipment, when you buy or sell intangibles, other long-term assets, and anything where you're paying or proceeds from equity or debt instruments where you're buying those in another entity. So not where we're issuing shares in ourselves, but if we are buying the shares of another entity, that's what's going to be in here. As well as if we are giving an advance or giving a loan to someone that we're expecting repaid in the future. So hopefully that makes it a bit clearer, a bit easier to understand what should be sitting there in the investing section. We're really talking about those, or it has to be something that's coming on the balance sheet as an asset that is intended to generate cash flows, generate profits into the future, something you'll use for the longer term. And the financing section, this is activities that result in changes in the size and composition of contributed equity as well as borrowings. So we're talking about share capital, the equity section of the balance sheet, as well as borrowings where we have received a loan from someone. So payments or proceeds when you issue shares, when you issue equity, when you redeem shares or redeem equity in your own entity, as well as borrowings. And the other thing that sits now in financing, now this might be a bit unusual or a bit of a trick for you, is cash payments by a lessee for the reduction of the outstanding liability relating to a lease. Think back to AASB 16, where we've said if you're renting something, it's not just a cash payment any longer of rent expense, but you're going to have the right of use asset, you're going to have the lease liability for the office space or for where you might be renting, and that now sits down in the financing section. Cash and cash equivalents, you'd think it'd be simple, right? Cash is cash on hand. It's your bank accounts. It's your petty cash tin, nice and easy. But then they always talk about this cash equivalence. Cash equivalents, they say, generally short term, generally something that's less than 3 months, highly liquid, readily convertible to a known amount of cash. So maybe a term deposit might sit in here because it's got an insignificant risk of change in value. And it's things that are held for the purpose of meeting your short-term cash commitments, not things that are held for longer-term investment purposes. And that finally gets us to cash flows. It's the inflows and outflows of the cash and the cash equivalents. The only note there is if you're moving money between your own bank accounts, it's not a cash flow. It has to be an inflow or an outflow with an external third party. Bank borrowings are not cash. Credit card isn't really cash. Credit card I'd treat it as trade or other payables for this purpose. The only time you might have a negative cash is if you've got a bank overdraft. And the standard there talks about a bank overdraft is that cash account where it's regularly fluctuating between a positive balance and a negative balance. And that bank overdraft can be treated as cash for the purposes of the cash flow statement. So a few tricks for you. Interest and dividends. We get some choice here. Interest paid, you get to choose between operating or financing. The standard says interest paid enters into the determination of profit or loss. So you might think of it as an operating transaction, but you could also see it as the cost of obtaining financial resources. So maybe it should be a financing transaction. I would see most organisations probably a bit of a mixture. There isn't quite a right or wrong between operating and financing, but take the pick of what's more suitable for the client you're preparing for. Dividends paid, very similar. Some people might say it guides you about the ability of an entity to pay dividends out of the operating cash flows, so should be seen as an operating transaction. Others would say, well, the dividends was actually the cost of obtaining your financial resources, so should it be a financing transaction? I'd probably more commonly see dividends put as financing, not as operating, but the standard gives you the choice. You've then got interest received and dividends received. And both of these, the same logic, they enter into the determination of profit and loss, so might be seen as an operating transaction, but they're also the returns on your investments, so might be seen as an investing transaction. So again, the standard gives you the choice. Neither's right or wrong. You look and see what's more appropriate for the client you're preparing the set of accounts for. So now let's see how everyone's done. Go through some answers of what the questions are. So I've got the 8 questions there. Some of you might be quickly scribbling on your page and changing your answers because I've suddenly told you that it goes not where you were imagining it was. But you can start writing in the chat, put the numbers 1 through to 8 with O, I or F next to each one to see what you think the answers should be. Till takings in a cafe. Apparently this was the easy one that everyone jumped in right at the beginning. It's an operating transaction. It's the receipts from the customer's category that is going to come into because it's the main operation of the cafe to receive cash when they sell their coffees. Bank interest received. Operating or investing. So if you said either of those, well done, you got it right. If you put it in financing, sorry. What do you think about the repayment of a Div 7A loan by a shareholder? Where is that going to sit in your cash flow statement? I've said this would be in the investing section, because if the company has extended a loan to someone that they're going to have received back in the future, it's an asset on the balance sheet, and when you receive it back, it's then coming in the investing section in that category of receipts for the repayment of loans. Hopefully
Oh,
you were
trick
probably
one.
looking at it and thinking, did I mislead you here? I just wanted to check if you're awake. If you issue an invoice to a customer, you've issued an invoice. There's nothing on the bank statement yet, so no cash flow. Not on your cash flow statement.
I think somebody did pick it up. I was like, what is this person saying? No cash flow. But yeah, well done to that person.
Well
I
done
got it
to
wrong.
those who picked up that I was trying to check if you were awake there.
I wrote,
If you put operating receipts from customers, you're thinking along the right lines. That operating receipts from customers will come when the invoice is paid by the customer, obviously.
yep, I put operating. It's the
Rent paid to the
post-Easter,
landlord.
post-holiday brain, fortunately.
Now, if you think pre-AASB 16, rent paid would have been sitting in the operating section of your cash flow statement, but now that we're all using AASB 16, rent paid is going to be a financing transaction that comes under the payment of lease liabilities. Just to confuse you all and remind you why everyone dislikes AASB 16.
Darn, I got this one wrong.
Sale of motor vehicles. You buy motor vehicles for long-term use, so they're sitting in the balance sheet as an asset. They'll be a investing transaction. You sell the motor vehicle and receive proceeds. So that's going to be proceeds on sale in the investing section. Pay staff wages, operating, clearly payments to employees. And dividend, I've said they're financing. Yes, I said a slide before, you can treat it as operating if you prefer. I generally find the financing is the treatment I tend to go with, but operating or financing both could be correct. So well done, pat on the back to anyone who got all of them correct.
Who got all of them right? Don't be shy. You can, if anyone did.
If
Well,
anyone did, you can show off.
well, I'm a tax accountant, so that's my excuse. But I got 4 out of 8. Oh gosh, it's quite shocking. Uh, anyway,
Taxes. No one likes taxes, right? Let's just talk about how taxes come into your cash flow statement quickly. So the standard says transactions about income taxes should be listed separately and shown in the operating section. So in your operating section, you should have a line item of payments made for income tax. The exception to that is if the transaction is clearly linked to an investing or a financing transaction, you can put the income tax portion that belongs to that investing or financing transaction in the investing or the financing section. It's much less common, and the standard sort of says, well, it can be very difficult to actually link up a individual payment of income tax to a individual investing or financing transaction, because often you're going to have timing delays that they may occur in different years. There may not be a direct correlation, so that exemption is there, generally much less common. Income tax in the operating section is generally what you'll expect to be there. The other aspect is GST. And in Australia, we've got this concept of GST should be presented on a gross basis. So what this is actually saying is that if you think when we receive money from our customers, our income statement might say $100, but the cash received was $110. So on the cash flow statement, we should show receipts from customers of $110 rather than 100. So we're grossing up the cash receipts for the portion of the GST received, And likewise on the payments to suppliers, we're grossing up the GST paid to suppliers. I guess practically the way you would tend to approach that would be that the movement in your GST account on the balance sheet you'd treat as a adjustment to the payments to suppliers, and then in the income section it's a little bit easier because most of the time you'd say all your income is going to have GST on it, so you can sort of take the total income for the year, add 10% on top as an increase in your cash receipts, and put the same amount as an increase in your cash payments so that your statement still balances. So just to add some confusion there. Probably one of those sections I see not always done so commonly, but technically required. And almost at the end of the theory, so we can then jump into some practical components here. So a few other points just to note down. Non-cash transactions don't come into the cash flow statement. If you've got depreciation, it's a journal entry. Your assets go down, your expenses go up. There was no cash flow. It doesn't come into the cash flow statement at all. If you have issued equity and then recorded a liability of cash receivable rather than a physically received the cash, there's no actual cash moving. The transaction doesn't come into the cash flow statement at all. There is this section that talks about the reconciliation of cash and cash equivalents. And I often see this in financial statements that people prepare where they say cash on the cash flow statement is $100,000, cash on the balance sheet is $100,000, therefore they're the same as each other. If they're the same as each other, you actually don't need to put that reconciliation in. Save yourself some time, just delete it out of the financials. If the cash on the bottom of the cash flow statement and the cash on the balance sheet are the same figure, no reconciliations required. Where it would be required is if you had perhaps some bank accounts with a positive cash balance and some bank accounts with a bank overdraft. If the bank overdraft is sitting down in the liabilities and the cash positive bank accounts are sitting up in your assets, then the cash number on your cash flow statement is going to be different to the cash number on the asset section under cash and cash equivalents. That's when you need the reconciliation that you put in the notes that says cash and cash equivalents $110, bank overdraft minus $10, net amount 100, cash on the cash flow statement 100, therefore they reconcile with each other. And payments by a lessee. So just to clarify here, you can find this details hiding away in AASB 16, where it says that the cash payment that's the principal portion of a lease liability is going to sit in your financing section. The cash payment that reflects the interest portion should be presented as interest paid, wherever you put interest paid in your accounts. And then the short-term lease payments, low value assets, that component, which is kind of the assets that we treat just as an expense and don't have a right of use asset, those components come into the operating section. So if interest paid is being treated as financing in your presentation, makes it easier because you don't have to split out cash payment of principal from cash payment of interest, and you can just then have a payments for leases with that full amount sitting there in the financing section of your cash flow statement. And just to note, just because it's in balance doesn't mean it's correct. If you get your cash flow statement and get to the point that the cash movement is matching up to the closing cash less the opening cash, great, you've got a cash flow statement that's in balance. You still need to go and think, have I got things presented in the correct categories? I would very frequently see cash flow statements where the bottom number balances, but when you look at the actual line items, they don't really make sense. There's one particular software that actually prepares cash flow statements for you as part of the pack, a very commonly used software. And I regularly see people generate the cash flow statement, but then don't actually go and look at it or don't make adjustments. And you get line items on there called other operating activities, other financing activities with these large balances. And you sort of look at it and think, well, I can see the bottom numbers in balance, but no one's actually looked at the statement and thought, does this make sense? Is it correct? So once you get it in balance, great. Step one. Step two, go and actually look. Have you got things grouped in the right places where you're expecting them to be? Direct or indirect? Two different ways you can prepare the cash flow statement. I'm only going to look at direct because I think it's easier and more helpful. There is the indirect option, but when you compare the two, investing section's basically the same, finance section basically the same, operating section in the direct method, you show cash receipts and cash payments. In the indirect method, you show operating profit, less adjustments for depreciation, less adjustments for interest expense, you add adjustments for trade receivables, you put these adjustments. It doesn't seem to be quite as helpful a presentation. So know that it's there. The standard actually specifically says to us, you are encouraged to use the direct method. So I'm just going to look at the direct method, ignore indirect. So great place to pause, see if there's any questions before I now jump into looking at some examples of how we might actually prepare a cash flow statement.
Cool. We have one question, and it's about who has to prepare a cash flow statement from Nicole. And the question is about how does the, complying with the Australian standards, requirement factor in with grant acquittals that need to be audited when the grant agreement template states, it has to be in accordance with Australian accounting standards. Typically, it's just the P&L of the grant, single statement being audited, so you wouldn't need to include a cash flow statement. Or is there something else specific that you should disclose in this case?
Grant agreements, grant acquittals, great fun.
Yeah.
Uh, what I tend to see is that government bodies or other providers that are providing grants will often provide a template that says, here's how I want the acquittal prepared, or here's how the statement signed by the CEO should look, here's how the statement signed by the auditor should look. And those statements or those templates, those guides, are generally not prepared and not written by accountants. So we come along and look at them and say, that's nice, but it doesn't quite line up with what should be there. There are some guidance documents that almost say to us as accountants, just because we're given a template doesn't mean we have to use the template. We're actually meant to use our judgment and modify or change it to make it correct before we sign off on it, rather than just saying, that's what they've asked for, so therefore that's what I'm going to do. So first step would be to say, well, actually, an acquittal is not a set of financial statements prepared in accordance with Australian accounting standards. An acquittal is a special purpose financial statement that might be prepared on a receipts and payments basis, or it might be a P&L just for one department. So first step would be modify note 1 to the acquittal to reflect what's actually been done rather than what the grant provider has told you to put in there. If you need to, go back to the provider and say, what you've asked for doesn't make sense. I'm going to change it to this, just letting you know. If the provider then comes back and says, I can't accept that. How dare you change what I gave you that's wrong to make it correct? You then jump into the ethical standards that give us some guidance on what to do in those situations and how you approach it. But in the first instance, see if you can delete out the word Australian accounting standards from the note 1 and put something that's more appropriate to describe what you're preparing, and hopefully that's helpful and answers that question.
That's great. Sounds like you've done it a few times before.
Yeah,
Uh,
more than a few.
yeah. Do we have time for one more question before we
Go
move?
ahead.
How are we going with time? Should be okay? Okay. Question from Andy. When you say the encouraged method, and this is between the direct and indirect method, does that mean the common or the preferred method is the direct method?
The standard says it uses the word encourage. That's specifically the wording in the standard of you are encouraged to use the direct method.
Mm.
So you have the flexibility. In terms of what's common, I would probably see the direct method used much more frequently. Um, I personally find the direct method is easier to prepare, and I find the direct method is easier to read for the users of the report and more helpful. So I would concur with the standard in saying I would encourage use of the direct method because I think it's easier and more useful, but it doesn't preclude you from using indirect if you choose to do so.
Yeah. Great. That was all the questions for now.
So, preparing a cash flow. This is the part where everyone kind of gets weak knees and kind of gets a little bit scared and says, oh no, can I just not do this? It doesn't need to be that way. And hopefully, I can show you that it's not really all that difficult. So, starting point, what do you actually need to be able to do a cash flow statement? You need a trial balance at the start of the period and a trial balance at the end of the period. Now, whether that period is interim reports for 9 months, whether the period is 12 months for the full annual period, it doesn't matter. As long as you've got a trial balance at the beginning and a trial balance at the end, and proviso there, they come from the same system and they're in balance with each other, you will be able to get your cash flow statement to balance, guaranteed. When I say the two are in balance with each other, what I'm saying there is if you have printed a trial balance 12 months ago when you did last year's annual return, and then after you did last year's tax return, the client's gone back and changed their transactions in the prior year, and you try and use the trial balance that you printed 12 months ago with the trial balance that you print today, you won't be able to get the statement to balance because the transactions in the prior period have been changed and that impacts the current year trial balance. So you want two trial balances, you want them to be in balance with each other. That is that the profit in last year's trial balance is the addition that comes to retained earnings to get you to this year's trial balance. If you've got that, statement can balance guaranteed. You will also need potentially the general ledger breakdown for some of the accounts. So for instance, the property, plant and equipment account, you'll need to be able to break down what was purchases, what was disposals. You don't need the bank statements, you don't need the bank account ledger. We're not going to go through the entire bank statement and try and code transactions. The cash flow statement, we prepare it by taking our already coded accounting transactions and using that to guide us of how we prepare the cash flow statement, what type of transactions would have occurred. So we're using our accounting knowledge to do it in a way that makes it reasonably easy for us. So, trial balance. I've gone with something that hopefully is a little bit simplified, and what you'll see here is when I prepare a cash flow statement, I like to take the client's trial balance and group it up into a summarized set of categories and then prepare the cash flow statement at that summary level rather than trying to do it at the detailed trial balance level. Now, what I'll show you here, you can do it either way. You could take the entire trial balance with every detailed account, but you can end up with 200 or 300 accounts, and it just becomes a little bit difficult to try and see what's happening and to prepare it. So if you're using a software that already groups the trial balance into shorter headings, makes it a bit easier for you. That's what I've taken here. So we've got a trial balance for the current period, a trial balance for the prior period, and we've got the movement column. So the first step to be able to prepare the trial balance is to calculate what that movement column is going to be. So what we're talking about there is for anything that's a balance sheet account, we're going to take the difference or the movement from last year to this year for each of the balance sheet accounts. For the profit and loss accounts, we're taking the figure of what it was in the current year. So you've got slightly different treatment for P&L versus balance sheet transactions. And you'll see in terms of the positive and negative, I've done it in a way so that the positives or negatives that I'm going to use is the same as the treatment as it will appear in the cash flow statement itself, because I find it's easier to think it through that way. So if I look at the line item of cash and cash equivalents, last year was 36,000, this year is 34,000. So that's gone down, cash has gone down by 2 grand. If I look at trade and receivables, we've got a negative as the adjustment. When you look at the income section, we've got income of 68,000, which was a credit. So credit would be there as a negative. When I put the movement, I'm putting a positive number of 68,000 because that's showing me positive of cash received, expenses of the negative cash outflow of 60,000. Seems all a bit confusing. When I go to the next slide, hopefully it makes a little bit more sense. What I'm then going to do is I'm going to take each of those movements and I'm going to categorize them between the different columns of where they might end up in the actual cash flow statement. So I've got some section for non-cash movements I want to exclude, the cash movement component, and then I've got my operating, investing, financing. Now in this case, I've hidden out some of the columns just to make it a bit easier for the simple example before I then in the second example, I'll do something a little bit more complicated. So we put the two together. We've got the trial balance and movements going down the page. Across the page, we've got the columns of each of the sections where those movements are going to be allocated to, and then we'll be able to add up each of those columns to give us the figure that appears in the cash flow statement itself. So we'll go through this line by line. You can try and think where do you expect each movement to appear, test yourself as we go along. So cash is going to go into my cash movement column, reasonably simple. Trade and other receivables. So what we're saying here is that trade receivables last year was 0, this year is now 40,000. So although I've issued a whole lot of invoices, I've not actually received the cash yet. So if you think about go back to your T accounts of what would you see in that trade and receivables account, opening balance was 0, closing balance was 40,000. What are the movements that's going to be sitting inside the trade and receivables? On one side, you've got invoices issued, and on the other side, you've got invoices paid. The invoices issued, we know what that is because that's sitting down in the revenue section that we're going to get to. So when you take the revenue and the movement in trade receivables together, you're getting back to the actual cash received. So I take the negative 40,000 of cash movement, and I'm going to put that into my receipts from operations or my receipts from customers, because the fact that trade receivables has gone up means that I received less cash than the invoices that I issued. Property, plant and equipment. It was 0, it's now 9,000. I've gone and purchased an asset. So I should be showing a negative 9,000 for acquisition of PP&E. I've paid out $9,000 to purchase the particular piece of equipment of whatever it might have been. Depreciation was 0, now negative 800. I'm going to put that into my non-cash movements because I don't want it coming into the actual cash transactions. There was no cash movement at all. Trade and other payables is the exact opposite of what we did with trade receivables. We see that there's been a movement of 19,000 in the payables account. So that tells me that I've recorded expenses, but I have not paid the suppliers yet. So I want to reduce the amount of the cash outflow that I'm going to show in the trade and other payables section by the amount of that increase. You've then got the borrowings. So Previously, we didn't have any debt. Now we've got a liability of 19,000. Obviously, I've gone and taken out a loan. The bank's given me 19,000 cash, and I'm now showing that I owe them 19,000 on the balance sheet. So I can put that into my financing section as a proceeds received from taking out a loan. The equity movement, if you think about equity, normally the only transaction in retained earnings is going to be last year's profit. And that's why I said you need to have two trial balances that are in balance with each other. Last year's trial balance, the profit figure was 7,900. This year's trial balance, the change in the retained earnings section, is that exact same figure of 7,900. Occasionally we find instances where people try and put transactions directly to retained earnings because somehow they think that credit bank debit retained earnings is a clever thing to do. If you've got a set of accounts like that, you won't be able to get the cash flow to balance, or you'll need to put an adjustment. So you're expecting to see that that movement in retained earnings should be exactly the same as what was the profit in the last year trial balance. Revenue. So you can see here we're ignoring the prior year column. For P&L, we're just looking at the current year column only. Revenue was $68,000. So if we assume there was no movements on the balance sheet, that $68,000 of income would be the same as the receipts from customers. So I'm putting that as a positive figure in my receipts from operations column. Interest income I've dropped over into the investing section. Expenses, opposite of revenue. Cash outflow, we put it payments to suppliers. Depreciation, I've gone and offset with the movement in the accumulated depreciation account. And because I've taken a trial balance that was in cents, but then grouped it up to whole dollars, I ended up with $1 out of balance that I've put as a rounding adjustment just to make sure everything goes through and balances. So at the end of the table, I can go through and add up the columns of each of those totals, and that gives me the numbers that I need to put onto the actual cash flow statement that I'm going to prepare. Now, if I wanted to double check that this was correct, I could go and add up the totals across the bottom of the operating, investing, and financing sections, and I'd find that that would be the exact opposite of the figure showing in the cash movement column. So I'd know that it was in balance. If we look at receipts from operations, I've said I've received 68 grand of income, but my receivables increased 40, so I'm reducing it. The net of the two gives me the 28,000 of the actual cash received. Cash payments, my expenses were 60,000, but my payables went up by a further 20. So net, I've actually paid out cash of 40,000. Hopefully you can see that presenting the cash flow statement calculation in that kind of tabular format, where you've got the trial balance, you've got the column for each of the sections and you add them up, should be a way that's reasonably easy to follow, reasonably easy to make adjustments and to understand what is happening there and why are we getting the numbers in that way. So comes out and looks like that, cash flow statement. I've just taken the numbers that were across the bottom of the table and then put them down the page in the presentation of a cash flow statement. So before I look at the reconciliation, which is the second component that everyone seems to dislike, I just want to pause and check if anyone had any questions about how that table type process works.
That's awesome. I think you deserve a DJ air horn. I should have been on this webinar when I was doing my fin for CA because yeah, you've definitely made it really clear and I really like it. Cool. Yeah, I don't know how I did it before I watched this. Yeah, anyway. Questions. Got a couple here from Michelle. For cash received from customers, revenue, do you need to gross up for GST?
yes, you do need to gross up for GST. I haven't presented it in this example, but
Mm.
yes, what you would expect to see is that you would say, well, I've received 28,000 of cash, and so I should have received 2,800 of GST. So if I was wanting to add the GST in the example, I would put an additional 2,800 GST in the cash received column and put a negative 2,800 in the cash paid column.
Okay. One more question from Alejandro. I hope I pronounced that correctly. How would a payment received as an agent, uh, how would a payment received as an agent will be classified? For example, a medical practice receives on behalf of a doctor $100 from a patient. Hmm.
Agent payments is, might have to take that one on
Yeah,
notice and come back. I've got a mental blank at the moment of what
this is more a
the specific
classification
section in
question.
the standard, so I don't want to tell you the wrong answer. I think it is that the agency payments would be excluded, but let's take that on notice and come back because I just want to jump in the standard and confirm I've given you the right response there.
Okay, and then Michelle has come back asking, what if that GST question, what if the revenue was a mixed supply, GST and GST free?
I would first say materiality and second say use an approximation.
Hmm. Hmm.
So if you know all the income is no GST, do nothing. If you know all the income is GST, put the amount. If it's mixed supplies, use some sort of an approximation method to give you a figure. End result, even if it's a little bit off, it's not going to be materially off from the financials.
Yep, great. And then I have a very, very silly question. I mean, presumably the software should be doing this for you, right?
I, most of the accounting softwares I've seen don't prepare a cash flow statement or don't do it very well.
Yep.
The do I say the blue is it the blue software gives you a cash flow statement, but it doesn't make it easy to make adjustments. So it gives you something that balances, but if you then go and say, well, actually, I need to make adjustments for non-cash transactions, it's not as easy to put those adjustments through. Um, the other softwares I've seen that try and prepare cash flow statements, I don't always find are very user-friendly or easy to follow. And even in our office, we've got a software that we use to prepare financial statements that has a cash flow module. And I still say to the staff, let's use the spreadsheet because I find it's easier to use and it's easier to visually see how it is preparing.
Yeah, yeah. Sometimes going back to the manual way of doing it is the only way to get it 100% correct. Yeah.
Yeah. And it's just because of the complexity of cash flow statements and because you can't always do it based purely on the movement in trial balances. Because what I haven't shown you in this example was if the actual, say in the instance of the plant and equipment section, if that was actually not just one asset that you purchased, but if you'd purchased some assets and sold some assets, you would need to take that amount and split it as partly purchase of PPE, partly acquisition of PPE, and you can't get to that detail unless you then jump into the actual general ledger for the account and split it up between the two.
Yeah, yeah. Understand, understand. Cool. I knew it was a dumb question.
Uh, so the reconciliation. Now, here's the good news with tier two, because the reconciliation of net operating cash flow to profit and loss, it sits there in AASB 1054 and tells us that when we've prepared the cash flow statement, we need to add in the back of our financials a reconciliation that says how do we get from the profit on the profit and loss statement to the um, operating cash flows on the cash flow statement and provide a reconciliation of the adjustments from one to the other. If you're doing tier one full general purpose statements, or if you are preparing compliant special purpose statements, you have to include this reconciliation. But if you're preparing tier 2 general purpose, so that's the simplified disclosure general purpose statements, you do not need to include this reconciliation. So that's one of the bonuses of going up from compliant special purpose to tier 2. You get to drop off this statement that looks a little something like that. You take the net profit or loss, you then subtract out the movements in depreciation, interest, and other adjustments that you might make. You then decrease or increase for the movements in assets or liabilities to get you to the figure that is the net cash provided by operations. That reconciliation is probably the component of cash flows that I find everyone says is the most difficult, and I'm going to show you why it doesn't need to be difficult. So keep in mind what we're trying to do. We're trying to get from the net profit or loss after tax through to the net cash provided by operating activities. If I were to put it in a table, it'd look a little something like this, and I've dropped some numbers in there, and excuse my bad handwriting on the screen, and but the letters and the colors there is to try and help demonstrate why this doesn't need to be difficult. We're starting with the profit or loss. We're taking the non-operating cash flows that are in net profit, we're adjusting for those. We're then going to adjust for movements in assets or liabilities to get us to what was the cash provided by operating activities. Again, excuse my bad handwriting on the screen, but if you look at it in the format of that calculation that I've just shown you how to do in the spreadsheet, the starting point was the profit or loss that was on the profit or loss statement. So if you think about where are those numbers going to be in this table, look at the red box that I've marked as letter A. Everything that was either an income or an expense is sitting there inside that red box that I've marked as letter A. We want to reconcile from that figure, that's the total of all the numbers in the red box, we want to reconcile it to the total of all the numbers that's in the green box marked D, because that, if you add up that section, is the column of operating activities. So hopefully you can see where I'm going here. We're doing a reconciliation of how do we get from the red box to the green box. We look at it and we say, what is in the red box that's not in the green box? That's everything I've marked in blue with the letter B. So we're going to take those out. We then say, what's in the green box that was not in the red box? That's what I've put in purple with the letter C. So we're going to add those items in. If you think about it and look at it in this way, you will always be able to get that reconciliation to balance easily, because it's in a sense really quite simple. You're saying, how do we get from the numbers in the red box to the numbers in the green box? You first say what was in the red box, not in the green box, take it out. You then say what's in the green box and not in the red box, you add it in, and you're done. Easy, right? I hope it's as easy as that. If I just jump back a slide, you can see how I've put the figures there. So I've said you start at letter A with what was in the profit. You've then got transactions that were in the profit but are not in operating cash flows. So you're taking out your depreciation, you're taking out interest received that you treated as an investing activity. You're then saying, what are the movements in the balance sheet accounts that came into my cash flow from operations, but were not included in net profit? You've got your movement in trade and other receivables, you've got your movement in trade and other payables, you've got your movements in your provisions. So you take each of those movements, and when you look at it in that way, that operating cash flow reconciliation, there's no way that it won't balance, because you're just saying, how do I get from one box to the other? You can see all the numbers on the page, and you're just adding in and taking out the numbers you can see there.
Great work. I think you have convinced the audience because someone has asked you to send them the template for this calculation for your whole trial balance reconciliation. Sorry, cash flow reconciliation.
Yep. Well,
Is that
you'll have it noted down, and I'll get in touch with that person offline.
okay?
So now I'm going to pull up Excel and see if I can do a live demonstration here. So do I say, here's one I partly prepared earlier. Now, um, I have tried to take a bit of a more complicated trial balance. I'm using exactly the same format of presentation as what I demonstrated in the first example. And I thought, well, I'll just work down and show you how might this come through. Now, if I was actually doing this for an actual client, I've actually got the formulas in this section pretty much pre-populated for all of the groupings here, so that once I copy and paste my trial balance in, the numbers almost flows through and makes it even easier because 90% of it's already done for you. But for the purpose of example, I've taken those out, and I'll show you if I was going to manually allocate them, then where am I going to put each of these movements into each of the columns that will come on the cash flow statement. So cash and cash equivalents, nice and easy. We always know that's going to be cash. Trade and receivables, even if you're not sure, you just step back and you say, well, what's actually sitting in that account? Trade and receivables, that's the invoices that I have issued out to customers, transactions with customers. So that movement there is going to be an adjustment against my receipts from operations. Sorry, I should just zoom in a bit to hopefully make it a little bit easier for everyone to see on the share screens there. Contract assets. Think back to AASB 15. What are contract assets? Where are they coming from? What have I got sitting in there? In a sense, it's almost like the new name for your work in progress, because that's going to be the payments that you've made to your suppliers for the work that you've done where you haven't actually been able to bill it yet. So that's going to be an adjustment to what I've paid to my suppliers. Inventory, suppliers again. Other assets, now obviously I've got this grouped up, so when I got here, I'd need to actually go back and see, well, what transactions are sitting there in other, and I'd find in this instance it was the prepayments. How do I get a prepayment? Well, I've made a payment to a supplier, but I haven't put it in my expenses yet because I've put it on my balance sheet, and I'll move it to my expenses later. So it's going to be an adjustment to my expenses. You know, current assets done. That was easy, wasn't it? Then I get into the PP&E section, and I've got a movement in my PP&E. Now, because PPE comes back to depreciation, I'll come back to the split here. For the moment, I'm just going to assume all of that was acquisition, but I know in my mind they bought and sold some things, so I want to come back. Accumulated depreciation. The movement there will, if we sold some things, maybe there's some adjustment to sale, but otherwise, movement in depreciation is going to be a non-cash transaction. Right of use assets. Doesn't everyone love AASB 16? We get to come all the way over to financing, payment for leases. Then we've got our depreciation movement, and we actually put some deferred tax on this one. So let's drop that into our adjustment for income tax paid. Trade and other payables. So talked about this before, payments to suppliers, contract liabilities. Now again, think back to AASB 15, contracts with customers. Contract liabilities is generally going to be the cash I've received from my customers that's not income yet. So That's going to be an adjustment to cash received from customers. Borrowings. Went and took out a bank loan. Let's come and put that over here as a proceeds from borrowings. Just go out a little bit just so I can actually not have to scroll quite so much, and then we'll come back. Payments for leasing is my movement in lease liabilities. Income tax, so let's drop that into income tax. Employee benefits, you can see where that's going to go. It almost feels reasonably easy, doesn't it? Provisions, what's sitting in my provisions? I've paid some, I've got my accrued expenses sitting there and maybe some accrued wages. So I'll drop those in. Got another movement in borrowing, so I can put that across here as my borrowing section. Lease liabilities, because we end up with current and non-current, great fun. Deferred tax, employee benefits. So you can see I'm just allocating each of these groups, and if I've set it up as a template, I can have them preset because they're always going to be there. Issued capital was 30,000 and now it's gone up to 230,000. So let's drop that over as, where are we going to put that? Issued capital has gone up. So we've received money and we have issued shares. And have I perhaps not even put in a column here? So I might just need to grab myself an extra column for issue of shares and come down and put my issue of shares over there. And retained profits is my movement in equity. P&L, this is the easy bit, right? Revenue, got money from my customers. Interest income, put that over as interest received. Expenses, we can drop in over here as payments to suppliers, depreciation, and then we've got some income tax and we've got some dividends paid. So I'll drop that over as dividends paid. And I made some kind of a rounding adjustment as well. Now, what I've done is, you might have kind of noticed it, I put a column to check I've allocated everything correctly, and as I went down, the numbers updated to 0. Just in case I put some numbers in the wrong spot, I'd know that every movement has been allocated and not over allocated. And if I look at the bottom, I can see profit from last year is matching my equity movement, but my depreciation has not come back to 0 because the movement in my accumulated depreciation accounts is not the same as the depreciation expense. Now I know that's going to generally occur when I've sold a motor vehicle. So I want to put a adjustment through. So I'm going to take 21,857 out of that column and I'll jump that over and put it into proceeds from disposal. And we were talking about GST before, so I might put some allowance for GST here. So should actually all be in balance now, right? Cash outflow, if I look at the start, my cash balance went up by 357,000 and I have allocated across the bottom here 357,000 of cash that I've received into each of the different categories. Great, it's in balance. Now the only next step is to say, but is it right? Does it make sense that I can say I've got acquisition of PP&E with a negative and I've got proceeds from disposal also with a negative? Now I remember when I was looking at the PP&E section, I needed to actually go and look back at the ledger and see, well, the asset balance has increased, but did I have some sales as well? What actually happened there? So maybe instead of just being purchases only, I might have had some proceeds from sale. Maybe got 400,000 there, and I just need to offset that. So I'm just adjusting between, taking the movement and splitting it up between the columns that it belongs to. Let's come and have a look. Those numbers look a bit more logical now and still in balance. Looks nice. Jump over to my outputs, and all I've done is just taken those exact same numbers and just put them in order down the page from each of the different sections. I think there might be a few hidden rows there, never great. So I'll just expand that out, and you can see each of the numbers we were looking at showing up in each of the relevant sections. Well, it's all in balance. It's nice.
Yay!
And I can even add in the formula to do the reconciliation for me. I've taken what was my income, what were the sections in the red box, not in the green box, what were the sections in the green box, not in the red box, and get back to what was my operating figure. So there you go, see? Easy, right? Um, so we can just then perhaps see, how is everyone feeling now? You can put things in the chat. Have I changed your level a little bit more towards green than red from where you were at the start of the presentation?
All right, don't be shy, people. Let's see, what are you feeling? 1 to 5. I think everyone will be like a 5. Uh, Alistair, if you just gave them your Excel template. Because that's what everyone seems to. I think we've got more than 5 people that have said, I want the template. So we'll have a chat offline. I'll try and negotiate something with Alistair, people. But for those, yeah, Andy's like, Excel. Uh, for those that want the template for now, later when we do the ratings poll, there will be like little feedback comment section. Please put down the word template in there so that we know that you want it. And then based on the demand, if there's a really high demand, then I'll negotiate harder for you folks. But obviously, you'll have to be a subscriber to get that. And also, just to let Natasha know, replays are available for VIP and team subscribers only. Back to you, Alistair. Looks like people
So
are
that
feeling a lot better, 4 and 5s.
I'm pleased to hear that, and that basically brings us towards the end. So we'll see. Has anyone got any questions? I've still got a bit of time. I know it was sort of hopefully haven't put you to sleep after an hour and a half of cash flow statements, but please jump in the chat. Oh, sorry, jump in the Q&A and put any questions that you might have or any follow-up that is still coming there.
Great. I think it was very mesmerizing watching you do that. It's like, oh, so this is what a pro in cash flow statements does. And someone said, Isabel said, I would feel better about it if we had your spreadsheet. Thanks, Isabel. Uh, so we'll just wait a couple more minutes for Q&As, people, and I'm just going to launch the poll. Thank you. Assistant Nugget poll, please. And like I mentioned, if you want the template, please put down in the feedback or the comment section the word template, and we will gauge the demand for that. Thank you, Assistant Nugget. In the meantime, while you're doing the poll and we're waiting for more questions to come through, Alistair, what was your number one key takeaway from today?
What was my key takeaway? I would say cash flow statements shouldn't actually be that difficult, right? I would hope that's what I've left you with, that it's something that we need to do regularly in preparing cash flow statements. And so if as you do it more regularly, you'll become more familiar. It should become a little bit easier, but definitely setting up a template, setting up a process internally is what makes it then the next step easier after that. Because if every time you prepare it, you're starting from a blank Excel file, it's going to feel difficult. But if you can look at a way to link it into the work you're already doing, and I guess that's where what I've shown you in that particular Excel file that I was demonstrating on, I've actually set it up to link into the codes that we use in the other financial statement preparation software that we're already using. So as part of our work outside of cash flows that we would have already been doing, we're already taking the client's trial balance, we're already grouping it up into headings that we use in our other aspects of our work. And so then I'm able to use that in the Excel where I can take that, copy and paste it in, and I've got the formulas set to link back to when I do the cash flow. I don't need to redo that grouping. I don't need to redo all the assigning because I've kind of got it set up in a way to then make it much easier for us.
Yep. Amazing. Looks like we don't have any more technical questions about the cash flow statement. I think, yeah, you've just showed everyone, yeah, like what best practice is, and I think that was really valuable, Alistair. Oh,
I'm very
Sashir,
pleased to hear that.
yeah, Sishir, I'm not sure if I pronounced your name correctly, but so recordings are only for VIP and team subscribers. You can jump into our website and have a look. We have a 10-day trial as well, so you can watch this replay as well as all of Alistair's replays. How many videos have we got now? Is it like 5?
Must be about 4 or 5. I think I've done one session at initially on preparing financial statements. We did a double session on income of AASB 15 and AASB 1058. We did a session where we went through and looked at AASB 16 on leases, and now preparing cash flow statements. And I think must be around about August, I think we're going to go through and look at how to do compliant special purpose financial statements. So
Yep.
something to look forward to a bit later in the year.
Great. One question from Joy. Can we just put net GST amount in the operating section rather than gross up?
I would say probably at least half the cash flow statements that get done are probably done that way. And technically the financials should be, you should split out the GST, but is it material for that client? Is it worth the effort? It's not difficult to add it in. So if you are going to do it, well, if you want to do the cash flow correctly, why not?
Yeah. Okay. I think, yeah, maybe let's leave it at there. Alistair, what do you reckon?
I think that's probably a good point to leave it. So thank you to everyone who attended. I hope you found it useful. If you haven't already, make sure you fill in the rating poll that has come up, and you can be in touch later on if you need to. So great place to leave it, and thank you everyone for attending.
No problems. All right. Thank you, everyone, for being such a good audience. And yeah, please put your emoji hands to say thank you to Alistair. Bye, everyone. Thanks for joining us. Thanks, Alistair.